It ain't easy. Fed Chair Powell spoke on Wednesday and the market seemed to be in the mood to go full bore risk on. The chairman started to talk about a soft landing and that led to stocks rallying, yields moving lower and the dollar moving lower as well. Maybe the moves were a prelude trade to the jobs report on Friday, which with the number of layoffs announced from big tech firms was due for something softer. The ADP at 127,000 or below would have been just fine. Following that up with a tamer CPI and a less hawkish Fed on December 14th, and maybe the year could end with dreams of sugar plums dancing in our collective heads, and a stock market rally and dollar selling off. After a Thursday's up and down session, the markets queued up for the jobs report on Friday. The data for the second month in a row had expectations at 200,000, and for the second month in a row, the number came in the 260s, this time at 263,000. The 261,000 number from last month was revised higher to 284,000, but admittedly the September number was revised down from 350,000 to 269,000 for a net 2-month revision of minus 23,000. So although stronger than expectations, taken as a whole with the revisions, it wasn't as strong at first glance. Nevertheless, stocks initially sold off, yields moved higher, and the US dollar moved higher as well. However, after the euro versus US dollar moved down toward its 100-hour moving average target initially, it found willing buyers ahead of that moving average target. The pound versus US dollar moved down to its 200-day moving average, the green line in this chart, and found buyers as well. The US dollar versus yen moved back above its 200-day moving average and up to the 38.2% retracement of the week's trading range and found sellers. The Aussie dollar versus the US dollar fell to its 100-hour moving average, the blue line in this chart, and found the same dip buyers. At first, it appeared to be profit takers at support/resistance levels, but as the morning hours moved on and the dollar buying did not show up, those dollar buyers turned to dollar sellers and the initial moves were reversed. Meanwhile, stocks moved higher as well, with the S&P erasing a minus 50-point decline to close down only 4.87 points on Friday's trade. That was good enough to close above its 200-day moving average for the third day in a row. The price had not closed above the 200-day moving average since April. So it is a significant move heading into the new trading week. That 200-day moving average comes in at 4071.71. That level will be a key barometer for the new trading week. The NASDAQ index, meanwhile, closed at 11461.51, which is about 40 points shy of its 100-day moving average at 11502. Put that number down as a key barometer for that index next week. With the US dollar's decline, the price of gold moved up 2.47% this week and closed just below its 100-day moving average. It's a nice round number of $1,800. For the week, the dollar fell versus nearly all the major currencies. Versus the euro, it was down minus 1.5%, the pound minus 1.65%, the yen minus 3.47%, the Swiss franc minus 0.96%, the Aussie dollar minus 0.63%, and the New Zealand dollar minus 2.58%. The dollar was only stronger versus the Canadian dollar by 0.68%. So with similar numbers to last month for the non-farm payroll and jobs report, we head into the new weeks in December with an eye toward the inflation numbers. The difference versus a month ago is the CPI last month was the week after the jobs report. This month we have to wait until the day before the Fed meeting on December 13th. Next week, the Reserve Bank of Australia is expected to raise rates by 25 basis points when they meet on Tuesday morning in Australia. The Bank of Canada will meet on Wednesday and are expected to raise by 25 basis points. The US CPI will be released on Friday with expectations of 0.2% for the core and the headline number. But it is really the CPI on December 13th that the market is focused on after its weaker 0.4% number last month. Remember, they're expecting 0.6%. the core was also weaker than expectations. As far as the Fed goes, don't expect any comments from Fed officials next week as they are in the blackout period until the rate decision on December 14th. The ups and downs are certainly not easy. As a result, that makes the technicals more important as they help to tell you when you are wrong, as well as give you confirmation on when you are right. I will go through the technicals now and outline the bias and risk defining levels in play as we prepare for the new trading week. All right, now that that's done, let's get into the technicals that are driving or will drive the market in the current trading week. They help define the risk, they help to define the bias. So we'll start off by taking a look at the euro versus US dollar. We'll start off with the hourly chart. Looking at this hourly chart, what I like about it to the upside is that the low price that we saw here on Thursday's trade was a nice little level to find support buyers against. This level was a swing area going back to a number of, weeks ago, if not months ago. The market came down into that area and found support buyers against that level, started to bounce back to the upside. And the move to the upside saw the price move back above the 200 and 100 hour moving averages. That's the green line right here and the blue line right here. Also near the blue line was the 200-day moving average. That's this green overlay line on the hourly chart. And breaking above that, really didn't look back toward that level again this week. On Thursday's trade with market in anticipation of perhaps a weaker number coming out on Friday, found early buyers against the 100-hour moving average, forced its way above the high prices from November. This is the first day of the calendar month. So it was a new break to the upside here, making new highs for the for the corrective move to the upside for the euro versus US dollar, and above the November highs in the process. Now on Friday, we did see the sharp move to the downside off of the jobs report, and that low price that we saw was similar to the low price that we saw right here. The low price came ahead of the 100-hour moving average and also near the 38.2% retracement of this move to the upside. Last couple of weeks move to the upside. So the inability to move below the 38.2, below the 100-hour moving average gave the another go-ahead to push to the upside. That was confirmed when we moved above the previous highs from November, the level right here and the level right here. And as you can see, when the market moved above that level right through here, what did we see? We saw momentum to the upside, confirming the break, and the price continued up to the high prices that we saw earlier in the day and on Thursday's trade, and we stalled out there near the 105.445 level. Now, why did we stall there? And to get that answer, we need to go to the daily chart and looking at it. First off, we went above the 50% retracement of the 2022 trading range. This is a high price, this is a low price, and the 50% midpoint comes in at 1.5155. Again, we moved up to around the 45 level off of the hourly chart, and the market stalled. It's not ready to move too far away from that 105.15 level, and perhaps it was the prior day's high and the highs through here that stalled the pair. But what we know going into the new trading week is that this 105.15 level, that 50% retracement level, along the old highs from November, will be needed to hold support in the short term to give the bias to the upside more room to roam. There is room to roam, but staying above those levels would be the best case scenario for in the new trading week. So keep that area 104.80, 104.96, 105.15.5 level as our early support for the week. Stay above is more bullish. On the top side, the next key target area comes in against this yellow area, this swing area. The swing area was defined by swing low through here, and then we have other swing highs through here where the market found willing sellers against the level, and then we moved above that area and found support against it through here, and then broke below and stayed below it on the retest right here. So a number of different swing lows and swing highs through here that form this swing area above here. and that's where the traders will be looking in the new trading week, as long as we can stay above the 50% retracement and above the previous highs from the month of November. That area comes between 106.19 and 106.34. So that's how I see the euro versus US dollar in the new trading week. Let's take a look at the dollar versus yen. And if we take a look at that chart from the daily perspective, this green line represents the 200-day moving average. And that moving average was broken on Friday's trade, and we closed below the level. We closed at 134.31. The 200-day moving average is at 131.50. So right off the bat, we know that if the market is going to continue its move to the downside, the best case scenario for the sellers would be for the price to stay below that 200-day moving average, or if it were to move above, not have much momentum, and then rotate back down below that 200-day moving average. So it's going to be a key barometer in trading in the at least at the beginning of the trading week. And if we hold below that level, the 50% retracement of the 2022 trading range would be our next key target. That's of this move from this low back in January to the high price that we saw in the month of October. The 50% retracement comes in at 132.70. Currently trading at 134.30, so that's about 60 pips away from the current level. On the downside, certainly something that's easily doable in trading next week. Below that level would look toward this swing area where we had a swing high, broke above it here, and then reestablished support against the level through here. Admittedly, we fell below that level here, testing the 100-day moving average in the process, moved back above it, and then reestablished early support against the level through here. So this area right down through here near the 131.48 level would be another key target to get to on further momentum to the downside. That's doable as well, so be aware of those levels on the downside for the dollar versus yen if the selling continues in the US dollar in that currency pair. A break above the 200-day moving average, what would that look like? And if we look at the hourly chart, what we saw on Friday was when the market moved above the 200-day moving average off the non-farm payroll initial reaction, where did we go? We went to the 38.2% retracement of the move down from the week's high to the week's low. A big move to the downside here, and then we saw the retracement up right to the 38.2% retracement. That is where the market stalled, and that's where we would look for the market to have to get to and through if the price is to move higher from here and not make a new low. So if we were to see a move back above the 200 and we see some further momentum, we'd want to see the price move above the 38.2% retracement and maybe then come down and start to look toward what would be the declining 100-hour moving average as the next target on the top side for the dollar versus yen. So that's how I see that currency pair in the new trading week. Let's take a look at the sterling versus US dollar. I'm going to start by looking at the hourly chart. And in the hourly chart, what we saw at its lows this week was a break below this key area through here. Look how this was a nice little ceiling through here, and then we broke above it here, and we came right back down to it here and found support level as you would expect. The retracement up here found resistance against the 100, so we had the battle going on, and that battle continued all the way until the market fell below the level on Wednesday's trade. We should have seen lower prices. We could not sustain the momentum. Once the price started to move back above the 200, back above the 100, it was all over. We saw a rotation back to the upside. We saw the buyers come in against the 100-hour moving average right through here, and that gave the go-ahead to push to the upside on Thursday's trade. That move to the upside tried to stay above this swing area through here, but the jobs report sent the number or the price falling to the downside, where the market broke back below the 200-day moving average. That's a green line. We broke above it on Thursday right here. And the market should have gone lower on the break of the 200-hour moving average, but we couldn't sustain momentum, and the market moved back to the upside. What I like about the way the day ended on Friday was the price tried to stay below this swing area through here. It could not do it. Once we broke above it, we moved back up to the highs, and we stalled near the high price from Thursday and the high price from earlier in the day. So we retraced the whole move, but could not get above the previous highs for the day. And if we go to the daily chart, we can get an idea of what was holding up the upside at the highs. And if we look at that daily chart, we can see that this swing area right through here was the reason. This swing area was had initial lows here, broke below it here, and then used the level as support through here. And then we fell back below it and used it as resistance through here. The last high right here came into that swing area, and that led to the sharp move to the downside, falling to the lows from Wednesday's trade on really good momentum to the downside. But then we started its rotation back up to the upside. And where did we stall? We stalled right near in this yellow area, which was the old support, old resistance. This swing area right through here between 122.78 and 123.31. And that's what we need to get to and through on the top side if this pair is going to continue its move to the upside. And up above, we have the 61.8, 124.50. Get above that level and opens the door for further upside momentum for the sterling versus US dollar. So in short, for this pair is the 200-day moving average is going to be key support in the short end, and this swing area is going to be key resistance in the short term. Get above it or below it, and that's going to define the bias at least at the start for the sterling versus US dollar. On the top side, we have the 61.8%. On the downside, watch the 50% retracement here as well at 120.50 level. Move below that level, and it opens the door for further selling in the sterling versus US dollar. Let's take a look at the dollar versus Swiss. I'm going to look at the daily chart for that currency pair. Because, well, we know the story about this. Lots of volatility to the up and downside for this currency pair. But I want to bring your attention to this swing area through here. There's a number of different levels all back here where the market found resistance and support at different times before breaking sharply to the upside. It took a while with lots of ups and downs to get back to that support area. But once we did through here, the market found the support buyers to push even higher through the last 3 or so months to the top side. And the last month has seen the price rotate all the way back down into the swing area where the November lows found support once again against this swing area between 93.53 and 93.82. During trading on Friday, we broke below that level but could not sustain momentum to the downside, and we're closing within this yellow area. That yellow area is going to be our barometer for buyers and sellers in the new trading week. Move above, it's more bullish. Didn't mean that one right here. Move above, it's more bullish, and then we have this swing area to get to and through. If we stay below it or move below it, it opens up the door for potential runs toward our low prices that we saw way back here in the month of March and April. Those levels will be eyed on further downside momentum for this currency pair. So we'll pay attention to them. But right now, we're sitting on the edge and looking for the next shove by traders either to the top side or the downside in the dollar versus Swiss. The dollar versus Canada, they had their employment statistics on Friday, and what we saw was came out about as expected. So the initial reaction was off the US dollar's reaction, and that was to the upside for this currency pair. Admittedly, the price action is a bit choppy, but there are some things that stick out to me, at least in the short term, for this currency pair. And it involves the 100-hour moving average on the top side and the 200-hour moving average on the downside. On Thursdays and actually the end of the day, Wednesday and Thursday, the market found resistance against that 100-hour moving average on a number of different occasions. We broke above it on the payroll number and then rotated back below it through here. Admittedly, we went above and below it through these hours through here, but closed the day with the market spending the last few hours below the 100-hour moving average. So that moving average is going to be our barometer on the top side. If we're able to get back above it, that I would open the door for a potential move to the upside, get above the swing area, and we start to move in that direction. On the other side of the equation, if the price were to move below the 200-hour moving average after finding support near it, during Friday's trade, we look toward this swing area. If we break below that level, it would open the door for downside for the dollar versus Canada. So two moving averages are going to be our barometers for this currency pair in the new trading week. Pay attention to those moving averages, the 100 and 200-hour moving average. Let's take a look at the Aussie versus US dollar. And again, we'll start with the hourly chart. And what I like about the hourly chart, a couple things favoring to the upside. One is at the low price right through here for the week, the market did find support against this old swing area here. Our old lows through here. We had lows through here, 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 up here, right here. We tried to base against that level. We had some sellers through here, admittedly, that formed this level, but the swing area held support earlier in the week, and the market based off of that. The other thing that is of significance happened on Friday, where the low price off of the jobs report saw the price bounce near its 100-hour moving average. That's the blue line in this chart. So we found buyers against that level and pushed the market to the upside. This area right here, where we had swing lows and swing highs, that formed it was a ceiling here and then became a floor through here. We broke above that level, and that's going to be a close support level in the new trading week. If the price can stay above that level, bounce off of here, we can go up to retest the highs through here. Alternatively, we could see a price move below that level, in which case we're going to look toward our 100-hour moving average, which is rising, and then the 200-hour moving average and this swing area. So lots of different levels going to the downside that the market would have to work its way through in order to increase the bearish bias in the Aussie versus US dollar. So buyers are in more control here in this currency pair, above those moving averages, above those swing areas. Let's just take a quick look at the daily chart. And what we know on the top side here is that there is some work to do on the top side, mainly because of this swing area through here, where the market found a number of different swing support and resistance levels through here. We moved above it right through here. That failed quickly, but then reestablished resistance against it, not only on Thursday, but again on Friday. Get above the 0.6859 level, and traders will look toward the 200-day moving average and the 50% retracement of the move move down from the high that we saw saw right here to the low right here. That 50% retracement comes in at the 0.6915 level. Again, that's near the 200-day moving average. So needless to say, that area is going to be a key level of resistance on the top side that would need to get to and through, in addition to this swing area right here. What was good on Friday is that the 38.2% retracement of the same move to the downside did find some support at 67.39, move below that level in the new trading week. Then traders will look toward the 100-day moving average at 0.66869 as the next key target on the downside for the Aussie versus US dollar. Finally, let's take a look at the New Zealand versus US dollar. I'll start by taking a look at the hourly chart in that currency pair. And the low prices from this week found some support against a nice little swing area through here. This yellow area here was defined going back in time, similar to what we saw in the Aussie versus US dollar. Go back in time where the market had a number of different swing levels right here, including the last time the market based against here, moving to the upside. So holding that level and then holding above the 200-hour moving average here and here gave the go-ahead to the upside. The corrective move off the high price didn't get near the 100-hour moving average right through here, nor the 200-day moving average, which is the overlay of this line right here. Those two moving averages come in at the same level, around the 0.628 level. So if the price were to move lower, get below the low price that we saw on Friday, we would be looking toward the 100-hour moving average and the 200-day moving average on the downside as the next key support level. Let's take a look at the daily chart for this pair. The price not only moved above the 200-day moving average with momentum through the Thursday and Friday, but we also moved above this swing area right here, defined by different swing lows and swing highs. The market went through that level on Friday, and that's good news for the pair coming into the new trading week. So close support was going to be near the 0.6377 to 94 level. Stay above that level, and we'll look toward the 61.8% retracement of the move up down from the 2022 high to the 2022 low. So this is trying to complete its lap that took a couple months from the August high to the low that we saw in October. Now back up to retest the high price here. Also the 61.8% retracement is going to be key resistance on the top side here for the New Zealand versus US dollar. So there you have it. Look at all the major currency pairs versus the US dollar. Some good levels in play. Some bias defining levels. Certainly the dollar selling is the strength here for the major currencies, and so we'll look for see if that momentum can continue in the new trading week, or do we hit these resistance levels outlined by my analysis and start to back off, maybe correct off a little bit from those extreme levels. My name is Greg Michalowski. Good fortune with your trading. Bye bye now.